While some online bullion dealers continue to charge $4 over spot for US Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and with us today is John Rubino from DollarCollapse.com. John, thank you so much for joining us today.
Hi Elijah, good to talk to you again.
All right, well, I'd like to first discuss about how the U.S. government is actually borrowing a surprisingly large amount of debt right now. Can you explain a little bit about this?
Yeah, it's an interesting thing that's happening out there now, and not just the U.S. China's doing the same thing. Normally, after a few years of recovery, and we're 6 or 7 years into a recovery now, the economy is growing pretty well, and a lot of people are at work and they're paying taxes, and so government finances start to look pretty good. In other words, deficits shrink, and it looks like the government is well run, and that had been kind of happening the last few years in the U.S. But in this past year, the amount of debt that the federal government has taken on has started to go back up again. It is exceeding $1 trillion a year now again. And the deficit isn't that high because the government actually borrows money that isn't reported in the deficit. But the deficit itself is also starting to spike again. And part of that is that it's an election year here in the U.S. And the incumbent political party, the Democrats, would like Hillary Clinton to win. And so they're doing what they can to generate some good-looking headline numbers in the economy so that Hillary's platform can say more of the same. We'll continue the progress made by the current administration. And that's a good thing to run on when it's demonstrable that good times are here. And if we're doing well, then staying the course is a good political platform. Meanwhile, over in China, they have created the most over-leveraged society that I think anybody has ever seen by borrowing tens of trillions of dollars to get out from under the 2008-2009 financial crisis. And they've never really stopped. They're borrowing huge amounts of money still, and they're encouraging the private sector to increase debt at an accelerating rate. Zero Hedge just reported that in the previous month, China took on almost $250 billion of new debt, which is a huge amount to take on in 1 month, and so what we're seeing out there under the surface is a lot of major countries accelerating their debt accumulation at a time when they should be paying off debt, or at least accumulating a lot less debt. So that implies, one, that when the next financial crisis comes, it's going to be extraordinary because we've leveraged ourselves to the hilt. We're much more deeply in debt now than we were in 2007, for instance, before the last crisis. And that when there's a downturn, these budget deficits and the rate of debt accumulation, which are already very high right now, are going to go stratospheric. They're going to go so high from here because governments already, even in quote unquote good times, can't seem to live within their means or come close to it. They still need to borrow huge amounts of money, and they still need to encourage the private sector to overborrow. So when tax revenues plunge and the private sector starts to contract, we're going to see a huge panic on the part of governments and central banks. And so the quantitative easing and the negative interest rates and excuse me, all the other stuff that we've seen that seems experimental and extreme is going to pale next to what comes after. And it looks like that there's a good chance that that's a 2017, 2018 story. It's not that far away. Because under the surface, again, when you get past these kind of fake employment numbers that the U.S. puts out, and inflation numbers that are mostly due to oil going back up and not much of anything else, the story is pretty weak. Manufacturing is weak in the U.S. The latest housing report had single-family homes growing, but multifamily homes shrinking, and the overall number was negative. And transportation, for instance, the transport of goods and services, which is a barometer of how the real economy, the economy of stuff, is doing, is shrinking dramatically in the U.S. So we're not really, and global trade is shrinking. China's imports and exports both fell in the most recent reporting period. So we're not seeing a growing global economy, even though most people think we're in a recovery. Now, governments are responding to that by borrowing lots of money, which makes sense. They see the real numbers, which are weak. And so they're responding by easing monetary conditions to the extent that they can. They're borrowing more money and they're spending it, and they're pushing interest rates down even further. And that's leading to, reasonably good numbers right now, but not great numbers, at least in terms of headlines, while the under the surface numbers are continuing to be very weak. So we could easily see a downturn in 2017, because remember, we've been in recovery, quote unquote, since 2009. So what is that? That's 7 years going on 8 years now. And that's a really long recovery. So the next recovery is coming. The under the surface numbers imply that it's coming soon. And when it comes, things are going to get really crazy in terms of monetary and fiscal policy.
Now, you're saying that there could be a collapse coming in 2017. Do you see that will happen either way, whatever the outcome of the presidential election is?
Well, some kind of financial crisis is pretty much baked into the cake based on all the new debt we've taken on. We're as I said, we're way more highly leveraged than we were before the last debt-driven near collapse almost blew up the global financial system. And I don't think that whoever's in charge really has the power to stop that. If the Democrats take over the government next time around, then we basically get more of the same, which is to say ever increasing debt, probably ever easing or monetary policy, no matter what the Fed says now about raising interest rates, which means the crisis just gets that much closer year after year. If we elect Donald Trump and the Republicans hold at least one of the houses of Congress, then who knows what happens? That's extreme uncertainty. And it might bring a crisis closer in time just because markets don't like uncertainty, and they might respond by drawing in. In other words, businesses won't want to invest. People won't want to buy risky assets like equities when they don't know what's going to happen. Alternatively, Trump could come right out with a bunch of business-friendly policies right away and reassure people for a little while. But there's no way that a President Trump stops the debt binge, just because that's not possible anymore. If we stop borrowing money, we collapse. So it's inflate or die, as Prudent Bear's Doug Nolan likes to say, and that's where we are no matter who's in charge. So it's not clear that any election can fix the mess we've created because it's just too big. The numbers are gargantuan. We owe so much money, much more than we can ever hope to pay off. We have to continue to borrow more and more money each year in order to keep our old debts from blowing up on us. And that's just the nature of the situation now. We've reached the point where a crisis is coming, and our only choice is one of type of crisis. First of all, do we have a 1930-style debt-driven deflationary collapse, or do we have the Austrian School of Economics crack-up boom where it manifests as hyperinflation? We devalue the currency so aggressively that nobody trusts it anymore. And do we do it next year, or do we do it 5 years from now? And that's basically it. So it's bad times, however you look at it, because we screwed up and borrowed too much money. Nothing mystical, magical about this, Elijah. If you borrow too much money, your life spins out of control, whether you're an individual or a family or a country. And every major country, by any reasonable measure, has borrowed way too much money. So we've got that to deal with in our future. And there's no way around dealing with it. There's only choices related to what kind of a resolution we want and which type of pain we're willing to accept.
Now, Janet Yellen recently spoke and said that we should consider having a high-pressure economy. What was your perspective when she said that?
Well, that's part of governments panicking. Basically, what she's saying, and the head of the Bank of England, Mark Carney, said the same thing also at basically the same time. He said, we're willing to accept above target inflation for a while in order to keep the economy growing. What Janet Yellen said was that in order to repair the damage of the Great Recession, maybe we need even lower unemployment. In other words, if 5% is full employment, 5% unemployment represents full employment, maybe we need to go to 4% or 3.5% or something like that, and create conditions in which there are just no free workers for companies anymore. And so they've got to raise wages really aggressively in order to keep the people that they have and hire new people if they want to do that, which will lead to wage inflation, which will take the headline inflation number up above the 2% target that the Fed has been talking about forever, but never really achieving. And she's willing to put up with that for a while. Well, that's, first of all, a sign of abject failure. You know, she is admitting that the things they've done that were aggressive and experimental over the past 5 or 6 years didn't work. You know, these incredibly low interest rates and this incredibly aggressive money creation and trillion-dollar deficits at the federal level did not give us a rip-roaring boom, which is what Keynesian economics says they should have given us. So she's going to up the ante and say, well, you know, if zero interest rates didn't work, let's make it negative. And if trillion-dollar deficits didn't work, let's go $1.5 trillion or 2 trillion. And if, you know, a 7 or 8% increase in the money supply didn't work year after year, let's go 10 or 15%. What this will really do in the real world is create instability, because people are going to figure out that, all right, the government is accepting 3% or 4% inflation, but my bank account only yields 0.02%. You know, what kind of a deal is that? So they're going to pull all their money out of banks. You know, extremely negative real interest rates are going to lead people to abandon the fixed income part of the financial system. So the only person left, or the only entity left, to buy all this debt that yields less than the inflation rate is going to be the government. So in effect, we'll have a government takeover of the debt markets, to the extent that they already haven't taken it over. And individuals seeing this aren't going to want to hold cash in any form because it's being aggressively devalued by the government. So they're going to swap it for real stuff. As soon as you get paid, you're going to go out and you're going to buy something that the government can't just create more of with a mouse click. And that's going to be farmland, other well-chosen real estate, some energy assets, and certainly precious metals. The gold and silver are the kinds of things that thrive in that kind of an environment when very few other things do. And while this is going on, the instability that is created by people rushing out of cash and into real stuff and pushing up the prices of real stuff will cause the financial markets to possibly spin out of control. You know, you get what the Austrian economics call, the Austrian School of Economics calls a crack-up boom, which is like a hyperinflation, which destabilizes a society. Think back to the 1970s when inflation was briefly at double-digit rates, and you saw basically financial chaos back then. You know, oil prices shot through the roof, and gold and silver went from a pittance to a really high level, to record levels in the space of just a few years. And everybody was terrified. They didn't think the system could hold together anymore. Well, quintuple or more all the debt numbers in the system, and that's what you've got today. So people are going to be even more scared than they were in the 1970s, and the financial crisis that will flow from these guys just trying to engineer really high rates of inflation and think that they can then just dial it back down when the time comes. The dislocations that are going to happen from something like that will be outrageous and really unpredictable. You know, you can't really know how a system is going to spin out of control once it spins out of control, because by definition, out of control means unpredictable. And that's what we're headed for somehow, some way, if the governments of the world do this. And the governments of the world don't really have a choice. They have to, according to their own models, their own worldviews, and their own self-interest, try to inflate their way out of the mess that they've made. And that's what Janet Yellen is talking about when she says a high pressure economy. She's saying, let's lower the value of the dollar at an accelerating rate and hope that fixes things. It won't fix things, of course. But she doesn't have anything else in her toolbox. All Keynesian economics has is easy money. When there's trouble, you lower interest rates, you increase government spending. That increases aggregate demand. In other words, people buy more stuff when interest rates go down or when the government is giving them money, and that makes the economy grow. Well, that works when people aren't already over-indebted and when governments aren't already over-indebted. But we're way past that point now. Everybody has borrowed way more than they should have, and they know that. So you can't lower interest rates, as we found, and induce people to borrow huge amounts of new money and buy stuff, because people have already borrowed huge amounts of money and bought stuff, and they've got their stuff and they've got their debt, and they're worried about it. So besides the high pressure economy that Janet Yellen is going to try to create with more aggressive monetary policy and more aggressive fiscal policy, we're going to see some stuff like the debt jubilee that people have been talking about for a while, or helicopter money, where we're going to see massive debt forgiveness on the part of the government. For instance, student loans. It would be really politically popular for somebody from the left to say, all right, all your student loans are wiped out. And that would, get the millennials spending a little bit more, but somebody has to cover that debt. That's the government taking all the student loans, trillion and some dollars of them, onto the federal balance sheet, which means all of taxpayers are on the hook for that. If student loans are written off, then what about car loans? I'm underwater on my pickup truck. Take care of me, please. And somebody else from the left will come along and say, let's do that. And then mortgages. Once you start this, you can't really stop, because every interest group, every constituency is over indebted. And if you help one, why aren't you helping the others? So just by not helping homeowners, for instance, you lose their vote because you helped somebody else and you didn't help them. So it becomes politically impossible to stop this process once it starts. And that's what we're headed for. So whatever kind of helicopter money / debt jubilee they try will cause more problems than it solves. They might try an infrastructure building program where the government borrows huge amounts of money and starts building new roads and bridges and fixing old bridges and airports and things. And what they'll end up with is a huge amount of federal debt. And then a situation like China's, where so much of the stuff that they built was really built for political reasons rather than market efficiency reasons. So you get empty airports where nobody flies in and out, and roads with no cars, and entire ghost cities. We'll end up with our version of that if we try an infrastructure build out, because every single congressman is going to want a chunk of that cash for his district, right? And it won't be the market deciding where this stuff goes. It'll be the politician with the most seniority or the most pull, or the most campaign funds or whatever, getting the biggest chunk of it and then deciding where it goes by allocating it to the people who contributed to his campaign. And it'll turn into a huge mess. So it might buy another few years of non-chaos, but at a cost of more years of even bigger chaos when the time comes. So there's no way out of this, Elijah. We can't get out of this painlessly. And everything we try to do to get ourselves out of it just increases the pain in the future that our kids will have to deal with. And possibly it gets a few of these politicians towards retirement without having to be blamed for all of this, but that's really the only good that comes of it.
I wanted to talk a little bit more about the economy and also a article that you wrote recently. There's been a lot of talk about the problem that Deutsche Bank is in right now, but you said that it's not just Deutsche Bank, it's the entire financial sector that is sick. Can you expand on that?
Well, yeah, Deutsche Bank is in the news lately because they basically became a debt addict. And this is Germany's biggest bank. It's the biggest bank in what is generally considered to be the most rock solid economy in the world. They borrowed huge amounts of money. They expanded into multiple business lines, which to an extent aren't very profitable for them. And they took on a derivatives book, which is basically a bunch of financial bets made by hedge funds and big banks back and forth that dwarfs not just Germany's economy, but the entire continental European economy. Deutsche Bank's derivatives book in notional value is bigger than Europe. So they're quote unquote systemically dangerous, which is the understatement of the year. If Deutsche Bank goes, it takes Europe down with it. And they just got hit with a fairly big fine for past financial crimes by the US that would force them to raise capital on really unfavorable terms because their stock price has been falling. So there's a potential death spiral scenario there where they have to raise capital to pay off their fine in the US, but they do it on such unfavorable terms that their existing investors start to bail on them, and then their stock price just tanks, and then their debts go bad, and then their derivatives blow up, and the European economy blows up along with them. That's the nightmare scenario that nobody wants to see happen. But by focusing on Deutsche Bank, you're missing the fact that lots of other banks are in bad shape. The Italian banking system is basically moribund. They, as a group, the Italian banks have a bad loan ratio of like 16%, which normally that would kill an individual bank. And this much bad debt is held by the entire Italian banking system. They're really in bad shape, and they're only being kept alive by government funds and other kinds of bailouts. Commerzbank, the second biggest German bank, just reported really bad numbers, and they're going to lay off 9,000 people, some huge number. I forget what it is, but it's a really big, scary number. So they're in trouble too. And the rest of the European banking system can't be in any better shape than the German banks are. They can be in better shape than the Italian banks are because they should really be gone by now. But wherever you look, you see a society that's over indebted and banks that are overextended. So it might be Deutsche Bank that blows up first, although it's hard to imagine the governments of the world letting that happen because it's so obvious. But it also might be the Italian banks finally giving it up, or French banks, or Spanish banks, or some US big banks, which are also big players in derivatives. So let one major derivatives player blows up and it takes down all the rest, which is exactly what you expect in a society that's grossly over-leveraged. The banks are the epicenter of the over-leveraging because they've got their fingers in everything, these big, giant financial supermarkets that are everywhere doing everything. So when the governments of the world take on too much debt, a lot of those bonds are held by the big banks. When the derivatives market passes a quadrillion dollars of notional value, most of that is on the balance sheet of these big banks. When the oil industry, for instance, borrows huge amounts of money to engineer a fracking boom in the US, and then the oil price drops by half, making a huge amount of that debt that was taken on non-performing, most of that's on the big banks' balance sheets. So the big banks are in multifaceted, huge amounts of trouble. And there's no way to know exactly what part of it blows up first. The whole oil thing could come sooner rather than later, though, because a lot of that debt was taken on several years ago when everybody thought fracking was going to be the next big thing and would go on forever. And therefore, you can lend as much money as you want to the frackers because they'll always find more wells, that kind of thing. A lot of that debt is starting to come due. So you could see an awful lot of oil patch defaults in 2017 that destabilize some of their bankers and start this ball rolling. That could easily happen. And of course, the Europeans are a mess in a lot of ways, so some of them could start it rolling. And China, as I mentioned, is insanely over-indebted and continues to take on new debt at a rate that has literally never been seen before in human history. So they could blow up at some point. You would think that just based on fundamentals, they already would have blown up. Their debt to GDP ratio is off the charts. And so it's coming. Something somewhere is going to blow up. It might be centered in one of the big banks, the big banking centers, or it might be something from out on the periphery that blows up and then metastasizes inward. There's no way to know because we've never been this highly leveraged around the world before. We've had lots of countries do this individually, but we've never seen everybody do it all at the same time. And that means that what's coming is inherently unpredictable because it's way more complex than, Argentina borrowing too much money and then having a crisis and lopping off a few zeros from its currency and then going forward as if nothing happened. This isn't that. This is much, much more multifaceted and complex with more moving parts, and therefore it's way harder to predict. And therefore, it might go on longer than just one country blowing up its currency because you've got so many different players able to chip in to moderate any given crisis at any given time. But by chipping in, they're borrowing more money. So you see the debt of the system ratchet up with each crisis. You can go back to the mid 1990s to see this process really get going, where every single thing that happened anywhere in the world, Alan Greenspan bailed out the big banks because they were on the hook for it at the cost of more systemic debt. And it's gone on like that ever since, from the tech stock bubble bursting to the housing bubble bursting to all the crazy stuff going on now. We meet every one of these emergencies with more and more debt. Eventually, we run out of the ability to do that, and that's when it all falls apart. It might also be a currency crisis where one or two major currencies just start falling, and the government that runs that currency can't figure out how to stop it, because normally stopping a currency crisis means raising interest rates like we did in the 1970s. We jacked interest rates up to 20% for a little while in the late 1970s, early 1980s. Imagine if we tried to do that today in response to a crisis in one of the major currencies. The whole thing would blow up. So we don't have that tool anymore. So it's easily envisioned that one or more major currencies start declining, and we don't have any way to stop it. And that spooks everybody and gets everybody looking around for what's next. And they find a target-rich environment out there. So it becomes short sellers' paradise and nightmarish for everybody else. And that's one of the very reasonable scenarios out of many. There are 5 or 6 different things that could all happen. And then a whole bunch of, known unknowns, things that we don't know that could blow up on us. And historically speaking, it's the thing you don't see coming that gets you. So that's especially scary because there are so many things we do see coming, and they're scary enough. But the idea that there's stuff out there that's even worse, and we don't see it because we're not aware that it's a risk yet, and that they might be coming too, well, it's a crazy world that we're headed for, Elijah, and there's no real pain-free solution. We just have to get through it and learn the lessons and hope that we invest wisely along the way. And that's mostly gold and silver for the average person. If you're buying silver coins right now, you're positioning yourself about as well as you can financially for what's coming, because there's no guarantee out there. There's no one stock you can buy that you know is going to go up and protect you from all of this. But precious metals historically have protected people from individual country crises. So hopefully they'll do the same this time around when it's the whole world.
All right. Well, John Rubino from dollarcollapse.com, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Well, you can find the stuff that I'm doing day to day at dollarcollapse.com. And that's a site that covers a lot of what we just talked about and that is updated continuously. So the idea is that you go there for an hour in the morning and you're kind of up to date on the gloom and doomy side of the world.
All right. Once again, thank you so much for your time.
Thanks, Elijah.